Mind Your Farm Business on RealAgriculture.com is brought to you by RBC Royal Bank.
Welcome to the Mind Your Farm Business podcast, brought to you by RBC Royal Bank. I'm Sean Haney, founder of RealAgriculture.com and host of Real Ag Radio on Rural Radio 147 Sirius XM. You can find more episodes of this podcast by going to mindyourfarmbusiness.com. Today's topic on the Mind Your Farm Business podcast is all about your year-end financials. For some of us, the year was a winner, and for others, it's definitely one to forget. No matter the kind of year that you had, reviewing your year-end statement should not just be left to the accountant. As the farm owner, manager, or executive, it's important to review your year-end statements to learn and build for the future. But what are you supposed to be looking at? That's a great question. To help us know what to look for in our year-end financials, how to interpret the numbers, and what barriers to overcome is Lisa Miller from MNP. Let's learn together. Here's my conversation with Lisa. Lisa, how are you doing today?
I'm good, Sean. How are you doing?
Great. So tell us a little bit about yourself and what you do at MNP.
Sure, yeah. So I am a partner in our ag practice here in Edmonton. And I've been with MNP for about 11 years. So I've kind of grown up in the firm. And one of the reasons I'm with MNP is just because I knew that I wasn't going to farm myself, but I did still want to practice in ag and work with farmers every day. And MNP has done a ton to invest in ag and work with farmers, and really is a leader in the industry in terms of tax accounting and advisory as it relates to ag. So that's why I'm here.
So today we're going to talk about year-end financial statements. And, there's different financials that you can work with on the farm. Some look backwards, some look forwards. In the case of year-end, it's a snapshot on the past. What are my year-end financials really telling me about my business when you think about the year-end?
Yeah. So what they should be telling you is, am I profitable? How did I do this year? I know we're going to talk a little bit about the different pieces of financials. So your balance sheet is a snapshot in time at your year-end date or whatever date it's reporting on. So that's kind of, as at that date, what do I own? What do I owe? And how much equity am I retaining in the farm itself? And then your income statement is sort of a running tally of, typically if we're reporting on a year, it's going to be, your revenue and expenses for the year, and what was your net income or potentially loss at the end of that year. So what they should be telling you is, in addition to, am I profitable, as the income statement looks, it should be, even things like, do I have significant or sufficient risk coverage for my farm? So even if we have a tough year, which I'm sure most everyone listening for 2021 is going to say, yeah, I had a really tough year this year. Even if we have a tough year, if we have sufficient risk coverage, we should still be, profitable enough given the hardships that we might have had in the year. So if we have a total loss, total meltdown, if we're in ag stability, we should hopefully be able to still cover some of that disaster. But really, especially in a grain situation, if we have, sufficient crop insurance, that should still be covering the losses that are there. Things like, where am I overspending? Where am I underspending? Because yes, it is possible to underspend, believe it or not. Can I service my debt payments? That's should be a huge focus, especially, if you're in an area that's had a couple of tough years. You should be able to ensure that you have sufficient profits in order to service your debt. Am I over leveraged? Is the size of my operation appropriate for if it's one family, two families, three families trying to live off of the farm? And am I financing long-term assets with short-term debt? Because we see that happen periodically. So that's something that your balance sheet can kind of point to you.
Yeah, there's a lot. I think when I think of the income statement, there's a lot of farms. I'm not going to exclude myself from this, where it's just really supernatural to just sort of your eyes to sort of like go right down to the bottom right-hand corner. Oh, we're profitable. All things are good. Like, you know what I mean? Like, there's a lot of stuff on all those different lines that tell a bit of a story, right? And they're interconnected in many cases. The bottom right-hand number is important, of course. And at the end of the day, that sort of tells the tale. But we got to pay attention to other stuff on that sheet as well.
Absolutely, yeah. And sometimes we can have the opposite problem where we're just kind of honing in, zeroing in, super granular. So I think, you can get caught on both ends of the spectrum, but it's really important to take a high level overview. And then when things aren't quite going the way that you hope that they are, you should be working with your advisor to really start to pinpoint, am I spending too much on my equipment? And that's really, a piece that we can kind of see happens frequently. We call it ironitis, where we're spending too much on big fancy equipment, and maybe the fleet isn't appropriate for our operation. So even things like that.
Yeah, good point. Now, there's the year-end financial, but there are some operations, and I think size maybe or complexity may have something to do with this. I'd like your feedback on this. How do I know if I should actually be doing something like a quarterly statement, where there's sort of like that, piece where so when we get to the end of the year, it's not like, surprise! Like we're sort of more up to date throughout the year. Where does that make sense?
Yeah, and I think that's actually really important, Sean. And it depends on the type of farm as well. Sometimes the bank makes that decision for you.
Unfortunately.
So sometimes the bank might say, hey, we want quarterly reporting. Sometimes we want monthly reporting. If we get into, I work with the CC lots, and so an operation like that, often the bank will want to see a touch point on a monthly basis or a quarterly basis. But I think it's really, to your point, super important that we don't wait until the accountant provides you with your financial statements. Hopefully that's in a timely basis after your year end, but maybe it's 6 months after. And at that point, you've probably seeded your next crop already. And you're like, 2020? Oh yeah. Okay. I remember 2020 kind of like it's not relevant anymore. Right. And so to your point, it's really important to have timely reporting as you're going through the year. So if you've got your books up to date, if you're working in an accounting software where you can kind of pull up those snapshots periodically and go like, hey, how am I doing? Is my balance sheet still healthy? How's my income statement looking like? A grain operation can be tough because it is so cyclical, but super important to keep your finger on the pulse on your financials.
And you noted both balance sheet and income statement there, so it's the case for both of those.
Totally.
Yeah, okay.
Yeah, for sure. Because your income statement is, like I say, a tally of where you're at in the year. But the balance sheet is going to give you a good snapshot in time of, and you should, if your books are up to date, you should be, and I'm not saying every day because we've got bigger and better things to tackle every day, but even if you're updating it on a monthly basis, I think it's good to just take a peek at that snapshot every month and see how things are going.
So we talked a little bit about some of the best practices, things to look out for, things to be paying attention to. Are there some mistakes or just poor practices that some people engage in that we should be trying to avoid when we're looking at our year-end financials?
Yeah, for sure. And I think that could be things like I say, I think a big mistake I can see run into is not having your books up to date. And again, we're not expecting you to do it every day, but I really think at least quarterly is a good practice to get into. But, monthly would be great as well. I do work with a few producers who, if they're December year end and then they call me in April and they're like, okay, I'm just starting on last January and I'm starting to get into it. I'm like, it's tough to have relevant, productive conversations if you're not keeping your reporting up to date. I think another, best practice to employ is have a team of advisors who really understand your business and who really can help guide you in the discussions we're having today. So what is important when you look at your financial statements? Your advisor should be helping guide you through those conversations.
Yeah, good point. And trust people you trust, right? I think
Absolutely.
If they're going to give you some advice, you're taking it, not just sort of like, yeah. Okay. Now we take those numbers. We've got them in front of us. They're accurate. They're relevant to us. We're trying to understand them. One of the ways that we can better understand them is using ratio analysis. Now, you mentioned the bank earlier. Sometimes the bank will even have this in our covenants. So we really should be paying attention to some of these things because we don't want to be out of line on our loan. What are some of the key ratios? We got a lot of different farms across the country, so I know some ratios are more applicable to certain kind of operations. But overall, what ratios do you think are important to pay attention to?
Yeah, that's a great question, Sean. And so I think you kind of hit it on the head. Oftentimes, if you're, have a certain size of debt with a lending institution, they will employ those covenants. So they will, they'll tell you up front, hey, here's the ratios we're going to prioritize, and here's what we want you to try and be hitting each year for those ratios. And those very often are, there's kind of three very common ones out there in the industry. The current ratio, so that's your current assets over your current liabilities. Debt service coverage ratio, which I actually think, especially now, in the area that I practice, the geographical area that I practice, that's been a huge one that we've really been focusing on in the last 5 years. And what the debt service coverage ratio is really looking at is your net income on your farm enough to cover your debt payments for the next 12 months. So you can see why the bank would find that very important to measure and compare your results to. But also we find it really important too, because we're finding a trend in the industry is farms are finding themselves over leveraged. And so they may start to have more debt payments in the next 12 months than what their farm is able to cover. And so it's something that we really pay attention to and say, hey, this is starting to creep into a territory where this isn't manageable. We need to talk to the bank or help you talk to the bank about making those debt payments more manageable for the operation. And then the other one, debt to equity, is really, I think of it as how much does a bank have invested in your farm versus how much you have invested in your farm. So your total dollars of debt owed to third parties versus what your equity or retained earnings are in the business. So those are the three super common ratios that the banks are going to measure, but we also as advisors think they're really important as well. And then what I look at with my producers is I'll go, let's take a grain farm as an example. So I'll break the income statement down on a per acre basis. So we're going to look at gross revenue per acre. We're going to look at inputs per acre. So that would be fertilizer, chemical, seed, and crop insurance. We're going to look at gross margin per acre. So that's revenue minus your input costs. And that's a really important metric because that's going to be driving what you can spend on your fixed costs and then hopefully have something in your pocket at the end of the day. We're going to look at labor, power, and machinery per acre, land building and finance costs. So that's going to be interest, land rent, property taxes, that kind of stuff. And then net profit per acre, because that's really, at the end of the day, that's a very important number. Something I say to my producers is, if you can rent that land out for $85 an acre and you're only making $50 per acre, there's a lot of other reasons why we farm, but it's just something to think about that, hey, if I can rent this to my neighbor than what I'm able to pull off of it, it's food for thought, right?
Yeah, good point. If I'm a rancher, am I looking at, revenue per cow? Like, what are some of those metrics that you use? Yeah,
so that's a really good thought, Sean. So we struggle to establish benchmarks on a per head basis sometimes because not all ranchers are doing the same thing as their neighbor, or even doing the same thing in their operation year to year. So if you're a cow-calf producer, one year you might, the markets might dictate that, hey, I'm going to start backgrounding my calves this year. And then next year you might, take those right to finish. And then the following year you might say, hey, I'm just going to calve out and sell those calves. So it becomes difficult to benchmark. But what we do kind of do this, a similar thing, and this would work for ranches, and it also works for mixed operations as well, because we have a lot of those, certainly in the geographical area that I practice in. So we look at those same sort of income statement chunks, if I can say it that way, but on a percentage of revenue basis. So we like to see your gross margin sort of hit around 65% of your total revenue. And then the same thing would apply for your labor, power, and machinery, and land building and finance, and net income. But we certainly can look at it on a per head basis. So on a cow-calf operation, on a per cow basis is typically how that would get measured. But it's tough, like I say, because not everyone's doing the same thing year to year. So
yeah, there's a lot of diversity.
That's why the percentages make good sense.
Yeah, there's a lot of diversity across the country for sure. We'll get back to the rest of the Mind Your Farm Business podcast, but first a word from our sponsor, RBC Royal Bank. This episode of Mind Your Farm Business podcast is brought to you by RBC. When you're running an operation, all risks can't be avoided, but many can be managed or mitigated. Dealing with uncertainty head-on means you can rest easier knowing you're in control. Set your farm business up for success with a sound risk management strategy. Visit rbc.com/risk management and speak with an agriculture account manager near you. Now, in Eastern Canada, we're talking about, if we focus on field crops for a second, for simplicity, out east, really good yields, high prices, high margin, some different issues that they're dealing with. Out west, we've got the other side of the extreme, drought, poor yields, high, trying to figure that out. We got some losses, or should have some losses. How do we reconcile that when we have extremes to the good or the bad? When we start to look at kind of like a multi-year analysis, so when we look at those ratios for this year, do we take anything from them because they're possibly outside of the normal numbers that we would see?
Yeah, I think so. And I mean, so I think your first question, when you look at east to west, I always say it's really hard to compare apples to oranges. The way that producers farm in Ontario is very different than how they farm around Red Deer. So trying to compare apples to oranges may not be fair on an overall basis. You might be able to say, even go on a crop basis. So if you're growing canola in Ontario and you're growing canola in Red Deer, should your yields be similar? Hard to say even then, right? So that's kind of a tough comparison. But I do think when we talk about when we have really tough years, like you say in the West, facing a drought this year, coming off of 2021, that's why it's so important that your financial statements show. We like to do a 5-year comparative because we recognize the significant volatility that's in farming. So if you're just looking at 2 years, that's not giving you a good comparative to analyze. It's also not giving your bank a great comparative to analyze. So we like to look at a 5-year, and then when we do face those really tough years, we still try to hold a strong benchmark, but yeah, we're going to give a little bit of grace and say that, maybe we're not expecting those, what it would look like when we have a bumper crop year. But again, I go back to my original point, which is you should have sufficient risk coverage on your farm so that you're trying to mitigate those big peaks and valleys in your operation.
Another thing you can do with your year-end financials is it's the lead into the coming year's budget. Any suggestions on how you use that?
Yeah, absolutely. So I think it's a good, like when you say, historical versus future forward looking, the historical is a good sort of foundation to frame what worked this year and what do we still need to improve on. And so if we identify areas that we still need to work on, if we take that ironitis example, if we're like, hey, we really need to tighten up on our equipment spending, that should be, like you say, really framing what your budget is going to be for the next crop year.
Yeah, well, think about fuel costs, right? So you can look at it and be like, well, okay, fuel costs are going to be higher because fuel's gone up in price. The other thing is I maybe didn't use a lot of fuel in 2021 because I didn't have any crop, so I was able, you got to think about those kind of parameters to those numbers, but at least they give you a starting point, a reality, and a bit of a context, right? Yeah.
And I also think part of your budget should really be looking at those benchmark numbers too. What are we striving for on our canola crop this year in terms of revenue? So that's going to take into your seeding plan as well as your marketing plan into 2022, just as an example.
Lisa, I think we need to do an episode of Mind Your Farm Business on budgeting. That would be a good one too. I think we've just sort of segued ourselves into a part 2 of this discussion. Yeah. Hey, Lisa, thank you so much for joining us here today on the Mind Your Farm Business podcast and talking about year-end financials.
Yeah, thanks so much for having me, Sean. It's a pleasure.
I know for myself personally, I have to really push myself and be disciplined to focus on finances. For many of us, we are building a business every day. Taking a day to do financial analysis seems kind of blah, but it's critical for all of us, no matter the size and scope of our business. Reviewing the year-end financials is something that can be done to a real benefit, as outlined by Lisa Miller of MNP. Looking at some simple ratios, comparing to prior years, and learning from the wins and the losses is so beneficial when it comes to strategy development and building our business for the future. I hope you enjoyed today's discussion. If you have any feedback or comments, please email me at shaney@realagriculture.com or call the Real Ag listener line, 855-776-6147. You can find more episodes of the Mind Your Farm Business podcast at mindyourfarmbusiness.com. Thanks to RBC Royal Bank. And until next time, keep on minding your farm business.